Welcome back. This is our late January edition of Chart Overload, which Justin says is not Chart Overload, but I think it is. I'm Mumy and he's JG. Glad you're here, Justin. Sipping your coffee. You got to go pinky up in a cup like that, though.
Sippy sip. It still is not chart overload.
Yeah, whatever. But anyways, let's get right to it. Let's get to the charts. We're going to start with the big picture. And this first one is a little picture of Trump's inauguration on the 20th. Justin, what stands out to you in this picture?
It's an interesting picture to say the least. I think first off, it just shows that if you are a tech billionaire CEO, you still are a slave to your phone during historic public events.
Yeah.
So other than that, I think it's pretty obvious what it shows. It basically just shows the influence or involvement that big tech seems to want to have in this administration. And I think it's I don't know the full extent of history, but I think it might be the first time in at least modern history where the nation's biggest companies, their CEOs and or founders are basically frontline at an inauguration. So very interesting to say the least. We got RFK Jr. in the background as well.
You can just see his broad shoulders.
And his tan. He's a tan.
He's supplementing. He's supplementing, yes.
He's on creatine.
Yeah. All right, let's get into it. This next one, it shows some of that soft data, small business optimism. I mean, if you could own the stock, you would want to have bought that in the last few months.
Yeah, and what's really interesting about this chart, and we put it right below the picture of big tech, is we obviously have the biggest of big businesses represented at the inauguration, but what this is a broad-based, well-followed survey of small businesses throughout the country, where basically people are asked, are you optimistic or are you pessimistic? And as you can see, there's been just an absolute spike in forward-looking optimism that the last time we really saw that was the last time Trump became president. You can see in the chart, back in 2016 into 2017, there was a similar spike, albeit from less depressed levels.
Yeah, keeping on with the soft data, we talked before starting the recording about this particular chart. It shows the soft data relative to the economic hard data. And as you see here, it's a couple of different colored lines moving up and down. Why don't you take our viewers through that?
Yeah, so hard data, blue line in this chart, so-called soft data, yellow-orange line, is basically soft data. Think of it as surveys. So outlooks, sentiment from business owners, in this case, small business, and think of hard data as actual, economic data that has occurred. So the obvious one being GDP, it could be jobless claims, so on and so forth. And of course, you're going to notice that oftentimes the soft data is more noisy than the hard data. But every once in a while, such was the case in late 2016 and present, you see a huge move in soft data, and then the big question remains, will the hard data catch up? And in this instance, it's, will the actual economy start to accelerate and catch up with what is now a very bullish, if not maybe euphoric, forward outlook.
And to our video, this is great transition. You'd think we'd done this before. To our first, video that we recorded in December, going to this next slide, will the hard data catch up to soft data? Well, what happens with inflation, right? Because that also will determine what the Fed does, which we said everybody's hyper focused on Trump, but we feel the man with the most to say over the direction of the markets is Jerome Powell. Take us through this next chart, Justin.
Yeah, so we've showed this, I believe, in the webinar, as well as I think what was the prior not chart overload series here. But basically, you can measure inflation in a variety of different ways, and this is just a forward-looking measure of inflation. So Federal Reserve, Bank of New York, and the University of Michigan put out what they call one-year inflation expectations. And as you can see here in both lines on the chart, it's down substantially from 2022, but it's starting to pick up here, and it's picking up more importantly at levels that are still above what was prior pandemic. So the big picture here is, animal spirits intact. Everybody's very bullish for, we think, reasonable reasons for the most part. But the real potential headwind, perhaps later in the year, is in fact inflation if that doesn't calm down. Because not only does that weigh on the consumer, but it also makes it such that the Federal Reserve can be less accommodative, meaning they're not going to be able to cut interest rates as easily.
Yeah, a couple more. We have a couple more big picture kind of charts. This next one is the City Economic Surprise Index, this is picking up as well, which has kind of been the trend of this big picture.
Yeah, and the thing about this chart is it really is often less relevant maybe for the stock market in the near term, but the bond market tends to respond pretty significantly to this, and we'll cover that in a later section of this video. But basically, you can see that into last summer, economic data really was coming in below expectations, and since then, it's now started to trend back up. And on the chart here, if it's above zero, that just means that economic data at large, as measured by this series, is above consensus expectations. So as expectations rise, it will be a higher hurdle for economic data to beat those expectations. So this is something we'll be keeping an eye on.
And finally is jobless claims. They're ticking higher, and they have been ticking higher.
Yeah, ticking higher, and there's a lot of good stuff to read out there if one wanted to go into the wormhole about how a lot of these traditional measurements have changed post-pandemic, just due to the fact that employment has changed, whether it be freelance type work, 1099 type job endeavors, etc. But regardless, we're seeing this move
gig
higher.
economy.
Exactly right, the gig economy. I forgot that term, but we're seeing this move higher. But interestingly, even though claims are moving higher, jobless claims, we've yet to really see that roll over into what is the headline monthly employment data. So this continuing claims is a weekly indicator. So again, the labor market is key, and we will be watching that closely.
Yeah, and it's not like a gotcha signal. So many folks try to make each jobless claims release like the gotcha and on directionality of the overall markets. But what we're paying most attention to is the trend. And fact of the matter is, with all the ups and downs in the bottom of that chart, the longer term line is moving higher. And we'll continue to pay attention to that because less people working is less money being spent, and we are a consumer driven economy, so it's something to pay attention. Next section, domestic stocks. What's going on the homeland? Our first chart, we'll take a look at the last really 2 months, what's happened in U.S. stock indices, and the answer is, Justin,
not a lot. So blue line here is market cap weighted S&P. So think of the companies run by the gentleman in the first picture as being dominant in the blue line, and the black line is the equal weighted S&P. So every company, regardless of its size, is weighted the same in the index, and made new all-time highs late November, early December, had a bit of a volatile December, and then we're back to kind of where we started. So been some volatility, but not a lot of trend, we'll say.
Yeah, and this next one, it's just talking about looking at CTA positioning and equity. CTA is a big institutional money manager, pots of money, and we tend to pay attention to what they're doing. But this chart shows they're kind of on their average positioning, going back the last 4 years, 5 years.
Which again, CTA is a very broad category, and we see a lot of people misrepresent the category in terms of its just overall impact on the market. But it is a multi-billion-dollar hedge fund category, and basically in some way or another, they tend to be long the market when it's trending up, and vice versa. And this most recent pullback in terms of their exposure has been, explained by the last chart. the market started to kind of go sideways to lower in December, so they reduced exposure. And we would expect that if the trend reasserts itself to the upside, these participants are going to be buying back into the market in the weeks ahead.
Yeah, and it creates a natural tailwind, right? Is buying creates more buying, is how I've heard it described before. Um, and this is another chart. The next one, obviously volatility. We talk about it a lot in our writings and in our videos. We feel it's a underutilized, explained, broad signal of what the sentiment is on actual people placing buys and sells versus just talking about it. And this chart talks about another type of fund or institutional trader, what they're doing with their money. What do you got to say about this here, Justin?
Yeah, it's pretty similar to what we described above with the so-called trend following participants, in that there's a huge swath of strategies out there of all types that basically, when volatility picks up, they get less aggressive, and when volatility declines, they become more aggressive. And sometimes this category of participants overlaps with the prior, the so-called trend followers, and sometimes firms will use a combination of both. But I think the big takeaway here is if you look back to 2017, when this category was very, very long the market, naturally that was a period of time where we had very low volatility for an extended period of time. And because we've had bouts of significant volatility, be it in particular last summer and, to some extent in December, this category of investors is not nearly as long the market as they could be. So there's potential here for them to start to reaccumulate if we do keep a muted level of volatility, which, we measure volatility in terms of what the market does day to day.
Yeah, very fascinating. Going on to our next section, non-U.S. stocks, and this is one of our favorite slides also in this slide deck, a popular meme that we got to make our own. So Justin, what's the story in non-U.S. stocks?
First, I want to say kudos to Mr. Ryan Mumy for constructing this meme. Anything's possible. Basically, it's kind of what we've been talking about. We talked about it in the webinar. We've talked about it in our commentary. I think we've talked about it in previous chart overloads. But international stocks and non-U.S. stocks have been so-called value for a long time, and they've continued to underperform. So this was no different last year. And what this shows here is if you're a value investor and you've had non-U.S. equities underperform for a very long time, you're going to be tempted to look the other way at the U.S. Mag 7.
And if you look to we'll go to the next slide. The numbers speak for themselves. This is cumulative outflows of overseas stocks and mutual funds. The outflows, meaning people redeeming and going elsewhere, was substantial last year.
Yeah, this just shows that, some 12 trillion Japanese yen basically moved out of Japan into the U.S. stock market. And this sounds crazy, but, the world's captivated by what's going on in the U.S. mega caps in particular. And, it's not just a domestic phenomenon. So will that eventually reverse, and will there be an unbelievable value opportunity in other areas? Perhaps, but as we've said numerous times, we will continue to see non-U.S. equities for now as a trading opportunity, and we're not going to slam our fist on the table and think there needs to be a big investment change simply because they do have, quote, relative value, because oftentimes that does not matter.
Yeah, what the saying is, the market can stay irrational longer than a investor can stay solvent betting against it. There's been numerous opportunities for people to say there's a value overseas, and they've done nothing but get crushed since doing that. So as we commonly say, absolutely, it will happen at some point, but instead of us, painting a picture and selling a story, we'd rather let the data point the way. And fact of the matter is the data still points to weakness overseas.
And just to tack on to that very briefly, oftentimes the narratives that you hear about this market, whether a global market or this area of the market, is quote unquote value. It's really just because there's a lot of legacy funds that are always investing in, value screened equities, and they're biased to say that, right? So we're trying to present a perspective here that really doesn't have a bias either way, but at the same time, we want to, give the benefit of the doubt to what's working and not try to, nail a big call in either direction, especially when it comes to value.
Amen. Getting a little more micro on the international front, this next chart talks about Brazil. Justin is going to do this next segment in Portuguese.
Yes. What's interesting about this is, we mentioned we don't want to be married to thinking that value indicators are going to necessarily matter to, forward performance, because obviously there needs to be a catalyst. But what's interesting about this chart is this is the Brazilian market relative to the broader emerging market space. And what you can see here is really since about 2021, 2022, Brazilian stocks have not just become very cheap, but they're cheap even relative to what are so-called other cheap emerging market stocks, be that in Asia or the rest of Latin America. And, again, we're not going to say that there's some sort of long-term buy and hold opportunity here, but there are certainly trading opportunities that, in particular, one of our strategies has, been keen to take advantage of several times over the past year.
Yeah, and as we often say, don't act on anything we talk about. Talk to your guy, your trusted professional before doing anything. But Brazil has presented some opportunities over the last 1 year that we've had some good favor with, and that could be setting up itself. That could be setting itself again. Let's move on to interest rates. Again, the area of the market that no one really talks about at cocktail parties, but controls a vast larger amount of money than the equity markets. Let's talk about interest rates. This first chart is talking about the U.S. government Treasury interest rates relative to what the Federal Reserve's doing. What is, digest this for us, Justin?
Yeah, this to me is, I don't know, it might be the most important chart out there right now, especially if you're just kind of, to Ryan's point, trying to focus on what's happening in interest rates, which often has a huge influence on what happens in stocks. And basically, this chart goes back to 1994. And ultimately, what it shows is the dark blue line is the Fed funds rate, so what the Fed is doing to interest rates. The light blue line is the 2-year yield, and then the gray line is the 10-year yield. And what you see here, in all instances until current, when the Fed would lower interest rates, rates would go lower. 2-year yields and 10-year yields would go lower. But what's happened most recently, and this is very interesting, is the Fed has cut rates by what is basically roughly 100 basis points already, and 2-year yields and 10-year yields have actually gone higher. So that is, at least in terms of modern history, that's been a big anomaly.
Yeah, data going back to 84 it's pretty clear. It's never happened before, where the 2-year, which traditionally what the Fed does, the front end of the curve, the 2-year treasuries and shorter maturities are going to trade really close to what the Fed does, right? The longer the 10 and then even the 30, that's market participants' anticipation of future growth and inflation rates. So there can be some dispersion there, right? But never has, going back 40 years, never has there been a scenario where the 2-year and the 10-year have risen when the Fed's cutting rates a whole percentage point, which they have done. So
yeah, and there's many people attempting to explain this after the fact, but one of the logical potential reasons for this is that the market is ultimately saying that the Fed cut rates too much recently relative to the fact that inflation is still high and the economy is still strong. So the bond market continues to move quite a bit with economic data, which teeing you up, Mr. Mumy, to segue to the next chart.
Well, you just do it, man. Just take my job.
Done.
Baloney. Yeah, this next one just talks about the long duration Treasury and the volatility, how much it moves around. A common way to measure this is the move index. This particular one just looks at the sensitivity of the longer maturities. And as it shows here, volatility is picked up.
Yeah, so very simple. Black line going up means that the volatility of long duration treasuries is correlated positively to the volatility in economic data. So, to our prior point, we saw economic data weaken into the summer, which moved the bond market a lot, yields lower. Since then, we've seen economic data strengthen a lot relative to expectation, which has moved long duration bond yields higher. And, this relationship is something we'll continue to pay close attention to.
Yeah, and this next one is more about expectations or forecasts, if you will, which you and I have talked about often how we put very little emphasis on other people's estimations of where things are gonna end up in time because oftentimes they're wrong, which we've shown um, numerous visuals to back that. But this one shows market and Fed expectations on where interest rates are going to go.
Yeah, and it's obviously very important to be aware of kind of what the market is pricing, what the market expects, and what the Fed is signaling they expect to do, and how that might be divergent in terms of market expectations versus the Fed. But big picture, what this basically shows is there's periods of time where if you notice the 2009 through, let's call it 2017-18 period, interest rates stayed completely flat at zero that whole time, and the market was constantly expecting rates to go up, and they never did. And you look at what's happened here recently, the far right of the chart, is we've kind of hit a point right now where, albeit it varies a little bit, the Fed's expecting to do another cut or so this year, and the market is more or less kind of right there with it. So there's really not anything to say or interpret from, the market thinks this and the Fed thinks this. Consensus from the Fed and the market is saying, we're going to get a couple more rate cuts this year, and beyond that, it's going to be all about the economic data.
Yeah, and where inflation heads.
Yeah.
Last section, let's talk about the commodities. And oil, obviously the biggest commodity. Our first chart covers goes back to 2020 on the price of oil.
So big spike into 2022. We've showed this chart a few times, but oil dropped notably from 2022 until really it kind of hit lows a few times over the course of 23 and 2024, which no doubt helped bring inflation down and helped the consumer. More recently, if you look to the far right, you can see there's been a bit of a jump in the price of oil, back up to the high 70s in WTI. And then this past week, it rolled back over. And, whether that be Trump continuing to proclaim that, drill, baby, drill, or, however you want to assign narrative to the price, this is a very important chart because if oil rolls back over here, that continues to be a tailwind for the economy. But if oil starts to actually trend back higher and really kind of break above some of these levels that we saw in 23 and 24, that ultimately really changes the dynamic quite a bit in terms of relative to what it's been the last couple of years.
Yeah, and just real simply, higher oil. It obviously takes some discretionary spending out of the economy, spending on other goods and services. It also puts pressure on inflation, which puts pressure on interest rates, which puts pressure on people borrowing money. So, again, it's all connected. You don't know the one for one connection, but that's why we talk about the trend and what it could possibly mean down the road. To Justin's point, if oil drops from here, I mean, that's could be gasoline on the animal spirits, right? It could also mean that the economy is really slowing down. So
Yeah.
again, they're all interconnected, but again, to Justin's point, if oil breaks above this high 70s, kind of where it's peaked out of late and gets into the 80s and stays there, you're going to see some spillover effect, and you'll start to see it in the economic data. You'll start to see it reflected in asset prices, and investors, will participate one way or the other. Final chart is another commodity, lithium, and basically, if you bought a lithium mine in 2022, I hope it was a small piece of your portfolio.
Yeah, this is obviously a very niche commodity, but the reason we thought it'd be interesting to point this out was many people probably will recall that in 2021, 2022, the dominant narrative was there's a shortage of lithium, that there's just not going to be enough because of the electrification of the world, electric vehicles, and flash forward today, there's been an absolute bust in that. Turns out there's plenty of lithium, and it also turns out that they completely overbuilt electric vehicles relative to demand. So, there's not to say that there's not a theme here longer term as far as, yes, lithium is a commodity that, according to some projections, is going to be in deficit, but it certainly isn't right now. And I think the key takeaway to this is anytime you're looking at a commodity and it's being presented as if it's some sort of long-term investment, you should really, really be skeptical of that, because it just very rarely, if ever, is the case.
Yes. I mean, that's also capitalism, right? When there appears to be a shortage of something, it's amazing the R&D that gets routed to finding or fixing or participating in. Something we pay attention to is similar to the peak in lithium. That the story of 21 and 22 was the new investment products available that allegedly track and invest in lithium, and people at various of our advisor partners would get phone calls, I got to own lithium, and there's nothing to act on, but it just kind of tells us that there might be more to the story. So anyways,
and just to tie one more, to connect our first chart to this last chart, is if you look at the big tech companies that were represented at the inauguration, those companies, when the share price goes up a lot, those companies make money and they buy back their shares, which ultimately supports share prices higher. So higher share prices can lead to higher share prices. Commodities, in this case lithium, are the exact opposite, in that higher prices incentivize everyone in the space to do more to ultimately drive down the prices. So we want to point out that looking at commodities and stocks as if like one can be replaced by the other in terms of an investment vehicle is not the way to do it.
Correct. Appreciate you coming back to this edition of Chart Overload. We'll be back in February with another one, and then later in the month with two. But hope you have a great week.